acquired. And therefore, let's go through the purchase consideration. P paid cash, immediate cash, 5,000 is there. Then P also issued share for share, 2 for 5. So you have to determine the number of shares P acquired. Remember, it is 60%. So P acquired 60% of the shares of S. The total number of shares of S is 5,000. Go back, look at the question. When I say it, don't believe it. Go check the figures for yourself. The total number of shares is 5,000 in S because the ordinary shares are issued at $1 and therefore there are 5,000 shares. So if they acquired 60%, 60% of 5,000 will be 3,000 for P, and therefore the remaining 40% will be 2,000, which is for NCI. So remember that. Okay. So the 3,000 divided by 5 times 2, which will be the number of shares to be issued, times the dollar of 1.8, because that's the market price of P's shares. P is the issuer, so we deal with P's share price, and that gives you 2,160. You have a deferred consideration where they will pay 2,000 in 3 years' time. They will pay 2,000 in 3 years' time, and the interest is 6%. You use that and you present value the 2,000, and that's where we get 1,679. All this you have to do for yourself. 6% for 3 years, the discount factor, and multiply by the 2,000. And then you get your total consideration of 8,839. And now your fair value of NCI. Remember, NCI is 20% of 5,000. Let me just put it here for you. 20% of 5,000. The number of shares in S. 20% of, or no, NCI, this figure is given in the question. So we don't even have to compute it. Yeah, we don't have to compute it because it is in the question. Let's go back to the question and confirm that. Where do we have it? So yeah, I found it. So make sure you find it yourself too. Non-controlling interest is 5,750. So it's given already. What I was doing was on the assumption that you were not given. But when you are given, use it. So we've been given the fair value of NCI. We add it to the purchase consideration. Our total net asset, we calculated it here. This is our total net asset. And therefore we deduct it, and then we have goodwill of 3,789. Nothing was said about impairment of goodwill, so it means this is goodwill at both acquisition and at the reporting date. It is not impaired. It is not impaired. So it's the same amount for the consolidated financial statement. Then you calculate your NCI, and since we are measuring NCI at fair value, you start with the fair value of NCI at acquisition, which is the same figure you used in the computation of the goodwill. So whatever figure you put down for NCI in the computation of goodwill, that same figure comes as your fair value, your first figure in the computation of NCI. Then you give NCI its share of post-acquisition profit, and we have computed post-acquisition profit to be 1,004. 40% of that will give you 560, and therefore your NCI value is 6,310 for the statement of financial position. Your group retained earning, parent, you start with parent's own 100% retained earnings. So you go to the parent side of the financial statement. The parent side of the financial statement, you can see ordinary share is 6 million, share premium is 6,000, share premium is 4,000, retain any is 12,500. So when you are preparing the group retain any, you start with 12,500, which is for parent, 12,500, and to that you add the parent's share of the post acquisition profit, which is 60% of 1,004. And then this is where it gets interesting, because the parent paid with deferred consideration, you must unwound for 1 year. You must unwound the discount or the interest cost in that present value for 1 year. So we calculate 6% on the opening deferred consideration. Opening deferred consideration. So 6% on 1,679. That's it. If you are consolidating for 2 years, if you are consolidating for 2 years, then you will calculate 2 years deferred unwounding of the interest for 2 years. If you are consolidating statement of financial position, please, we are learning to consolidate statement of financial position, and the balances you have, the accumulative. It's not the same rule for profit or loss, so I don't want you to mix it up. I'm talking about statement of financial position. If you are consolidating for 2 years, you calculate staff for 2 years. If you are consolidating for 1 year, you calculate for 1 year. So here, this consolidation is for 1 year, 2006 to 2007. Yeah. So you unwound the interest for 1 year and deduct it. It's a charge. Debit to, when we say debit to profit or loss, it means you debit it to group retained earning. And so once you do that, you have your consolidated, your group retained earning for consolidated statement of financial position. Now, after that, you can go ahead and consolidate. But let's have a quick discussion of some of the items you have in the statement of financial position. You can see that in the parent's financial position, we have share premium, ordinary share and share premium, and therefore the shares that were issued for 1.8, you have to record $1 as share capital and 0.8 as share premium. You have to do that. All equity items must stand out, and you will introduce NCI right after retained earning, before non-current liability. These things you have to learn and master them. Okay, so give yourself a try on preparing the consolidated financial statement, but let's still go through for the sake of where do we have it? Okay, all right. So you go ahead and consolidate for yourself. If you consolidate, you can come back to me and let's discuss what it is. Thank you.